All right, Mr. Scott Wallace, I am so glad to have you. Thank you for taking the time out of your very busy schedule to hang out with us for a few moments.
Absolutely. Happy to do it.
So I don't know if you've heard, but apparently some things have gone down in the financial sector over the last 48 hours. Have you heard much about this?
Just a little bit. Yeah, a little bit of,
Well,
chatter.
chatter. What I wanted to do is just real quick go through a couple questions. You are the resident expert, right? So look at all those awards back on that wall. Good grief. What's going on back there, man?
It's wallpaper.
So you obviously have the expertise, the wisdom, and the experience to answer these questions. So I just got a couple questions for you. Would love to hear your feedback, and I want to share this with the people out there who just may not have any idea what's happening, who may be scared, who may not know the facts, and we can share some truth with them and maybe help get them settled down and at least with the right information, right?
Okay, sounds good.
All right. So what is happening with the bank failures and why?
Okay. So first of all, it's just about what happened. So what happened is that the bank really just misplaced their risk assessment, right? They had funds. You know how banks work. We give them their money, they use our money, they make investments. Okay. So they took a lot of their investment and they put them in, they're really designed for short-term assets, but they put them in long-term 10-year bonds, okay? Long-term investments that don't mature for a certain period of time. So in this age of information is at the split second, you can move money with the click of your phone, right?
Sure.
So as people came to that bank to pull funds out and do things with the money, they couldn't cover the money because it was too many people coming to get money, right?
Right.
So they couldn't cover it. So if you go to take a long-term, if you did a 10-year treasury bond, and bought that, it doesn't mature for 10 years. So for example, if you have a 401k, if you look at your 401k and you've lost money, have you really lost money? No, you don't lose money unless you actually realize that loss by taking the money out. Same thing with that bank. They have the money in the bond and it's secure and it's safe, but they need the money now to cover what they need to cover. And it wasn't working. There's not enough money. The Fed got involved, saw it happening, came in, shut them down to protect the consumers out there and their funds. So that otherwise it would have been a real mess. So the problem is that other companies, and then most of them are on the West Coast. First of all, those companies have invested with SVP. So as one thing falls, they start to have some problems with their investments, and it kind of snowballs a little bit. And that's kind of what's happening right now. The biggest thing is that it has no direct effect on our local market. No direct effect. Now it has some indirect effects. Like today, you see that people across the board, whenever you hear something that's failing, that's scary. It's our money, right? You don't want that to happen. So people are pulling money out of riskier investments and putting them into really short things, gold, hard currencies, things that are just, they don't rise a lot, but they're pretty safe. And if I need to get to them, I can go get to them.
Right.
I can go grab them and pull them out. So when they're doing that, that's caused the 10-year treasury yield to drop, and it has dropped 50 basis points. Trying to see if it's up yet. Yeah, about 50 basis points it's dropped, which directly affects our mortgage world. So the rates have come down. I'm going to say that's not a bad thing. That's a good thing that the rates have come down. We hate it for what's happening out there, but that will resolve itself. There are some bigger issues at hand regarding that. We'll get into a little bit later, but there shouldn't be any fear mongering because of a bank in California that got caught with their pants down.
Makes total sense. And really, Scott, that's a great explanation. Thank you for kind of covering that. There's so many shades of 2008 in people's minds.
It's not that at all. No,
right. Not at all. So thank you. Right. So thank you for helping us with some clarity. So in that vein, is there any cause for alarm at all for the local housing or mortgage markets? And talk a little bit about the Fed limits as well, Fed pause at the end of that explanation.
Housing and mortgage worlds are all localized. It doesn't matter so much what New York's doing or California. It matters where we are. We're living and breathing here. So the short answer is no. It has no effect on us right here. The indirect things we already talked about with the mortgage rates falling, which is fantastic. If the Fed decides to pause, and the Fed has been, there's a lot of things we can talk about with the Fed and what they've done and how they've created some of this mess. So they have this idea of having a 2% inflation rate. So the Fed is fighting inflation at the same time dealing with this thing that's going out there and trying to save, some investors and try to calm some fears in those localized markets out there. And obviously when fears start to happen on one side of the world, it's gonna trickle to our side. So the Fed, they could pause. It's possible they could pause raising the Fed funds rate. They may increase, but made at a smaller clip instead of 50 basis points or 100 basis points, which they were thinking about doing, maybe a quarter. Either one of those, if they pause it or even slightly increase it, that's good for our rates. It's going to stabilizes the interest rates. It's going to stabilize the stock market. They're going to like it if the Fed stops doing, these continuing raises. But they're just seeing a bike running downhill that has no brakes. And that's what they see our economy doing. It's just, and our economy wants to take off, but the Fed's trying to, taper it down. Okay, we don't go too fast. If you don't have any brakes, you're going to hit a tree and you're going to get killed. A hard landing. So they don't want that to happen. So if the Fed does do that, they may do it just to kind of give a breath. Okay, everybody just breathe for a minute. The Fed, jumped the rates up 500 basis points in like 6-7 months. I mean, businesses don't have the opportunity to pivot because it just keeps changing. It's changed so drastically, so quickly. It's caused a lot of grief. My personal opinion, I wish they just stop. They're not going to stop. They're probably going to keep going because they want to get to 2%. They want it, heck or high water. They want to be at 2% inflation. They probably could get to 3% and the economy could be still in a great position and inflation rate still at 3%. And that's not too god awful. A lot better than it is currently at 6%. So
what's the general outlook for the interest rates for the local housing market in, let's say, the next 6 to 12 months?
Okay, so we see, in the next 6 to 12 months, we see rates maybe being in the 5s, actually. We see the rates could be, by the end of this year, be in the 5s, and that would really be fantastic. I think the housing market, you can speak to this, but I think the housing market is great. I mean, the housing market valuations are still high. The rate of increase may have slowed down, but we still think there's going to be 5 to 8% a year. And that's, not double digits, but, it's just the rate of increase has slowed down, but the valuations are still high in this market. It's a hot market. The Southeast is a hot market, right?
We're still seeing multiple offers. In fact, one of mine just had an offer sight unseen on it. Sight unseen, which I haven't seen in a while. Multiple offers, multiple showings. This weekend we were out at a property and there were people everywhere. It reminded me of 2021 all over again.
When I look at it, I go, okay, you got builders out there building houses, trying to create inventory. It takes a while to get houses built and get communities going, get the excitement of communities and those things going. If I'm a seller and I'm sitting there, I'm thinking about selling my house, but I go, no, I don't want to sell my house right now because the rates are high. I don't know where I'm going to go. And then I start looking, I start seeing all these subdivisions starting to go up around me. And I'm going, you know what? In 6 to 8 months, my house may be worth a little less in comparative to that brand new house that's giving out warranty and all the brand new paint and the brand new appliances. I think, honey, I might want to we might want to reconsider doing this now because it might be better for us now than to wait. What are your goals? What are you trying to do? But the market itself here is great. I think that we're in a great position. We all know this, right? We all know we're in a great area in the sunny South.
Wise words from a mortgage professional of a quarter of a century with a wall full of trophies.
Whoa!
So if someone listening to our broadcast today has questions for you, how can they get a hold of you, Scott?
Okay, they can call you because you'll send them straight to me. Or they can my office number is 803-547-8464. My cell is 803-493-0145. You can text me. You can email me at swallace@1asmc.com if you'd like. If you do it that way, that's fine. But yeah,
excellent.
And there are a lot of things that are going on in the market right now besides what's happening here that you need to be involved with your mortgage person. You just need to be, because there's some things that, when it comes to loan level price adjustments on Fannie and Freddie and the conventional loans and debt to income ratios that can affect your closings. You might have lock loans that get changed in the middle because of it. So there are things that you need to talk to your mortgage professional about because there are changes in the market over and above what has just happened. I'm not saying it's an absolute nothing burger, but it's not affecting us like I think that maybe people out there you're talking to are going, what in the world are we going to do? Are all the banks going to fail? We don't have any money left. What are we going to do? It's not like that.
Right. There's a self-generated fear that permeates and creates the very thing it's trying to avoid, which is what we need to be very cognizant of. So,
Well,
yeah,
fear begets fear, right?
that's right. That's
Right.
right.
So faith begets peace.
Come on, brother.
Have faith in your
Come on.
abilities, faith in your market, faith in, if you're inclined, faith in God. If he can move mountains,
We
Marcus,
are inclined. We are.
he can move a house.
Well, and we don't want to be Pollyanna about this, but we don't believe that the sky's falling either. Facts are important, that we know exactly what's happened, that we know what is happening. I think
right.
it's key because, Scott, we've covered kind of a 30,000 foot view today, but I know there's micro questions that a lot of these buyers and sellers are going to have. So reach out to Scott, ask him some questions. Certainly reach out to me. We can answer more of these questions on a specific case by case level for you guys. Thank you for listening today. Thank you for tuning in. I hope that you've got something out of this, and let's go take it and let's share the truth.
Absolutely. Thanks,
Thanks,
Marcus.
guys.
Appreciate
Have
it.
a great day.